Good morning, everybody. I have 9 o'clock on the dot here, and so I think we are going to get started. Welcome, everyone, to day 2 of the Not-for-Profit Seminar with Cherry Beckert. I am Matthew Saha. I lead the not-for-profit industry practice for the firm. I'm extremely happy to have everyone joining us. We have over 200 folks logged in, about 220 now at the last minute logged in. Have a great session to start us out today. So first, before we get into our speakers, I wanted to just go over our housekeeping items as we've gotten used to. Again, to receive CPE credit for this, you're going to need to answer at least 3 of the live polling questions. There will be 4 polling questions altogether, so if you miss one, don't worry about it. But those are our way of tracking attendance and attention. So there will be no other ways to track attendance other than answering those polling questions. So please do that. In addition, we'll have a short survey that will pop up at the conclusion of the seminar. We'll also send that out by email. So if you missed it, don't worry about it. It will hit your email inbox as well. We're going to be issuing CPE certificates for this within 10 days of the close of the seminar. So watch out, those will hit your inbox. If you have any issues or don't see it after 10 days, please then reach out to us at cbhlearning at cbh.com. There will be a recorded version of this going on to our website that will be available about a week from today. And then also, if you have any questions during the seminar, please use the Q&A tab at the bottom of your menu options. Those are where it is best to answer questions. We'll try to answer as many of those as we can live during the seminar. If you have any items that you just want to contribute or want to chat or have some commentary, you can use the chat box, which is located down there, sort of a little bit to the right of the Q&A tab as well. So with that, those are all our housekeeping items, and let's get into our first session for today. So I'm very happy to have with us my good friends from Adavoco. Adavoco is an endowment management and service company that specializes in endowments. And Chris Davis, who is with us, is the co-founder and CEO of Adavoco. And I'd like him to tell you a little bit more about Adavoco, and then we'll introduce our other panelists. So Chris, I will turn it over to you.
Thanks, Matthew. And thanks to all of you for your time today. As Matthew said, I'm Chris Davis, and I'm joining you from a sunny but a little chilly Norfolk, Virginia today. And I co-founded Adavoco with my brother, Stephen, in 2011. And we had a clear mission at that time, and that was to engineer and deliver to nonprofit organizations the world's best endowment administration software and related professional services. And by endowment administration, we mean all things endowment across your organization. And that could be in finance, endowment accounting for investments and fund balances. And advancement, it could mean stewardship reporting and gift receipting. And financial aid, it could mean awarding, budgeting, scholarship matching. And importantly, we also mean our endowment accounting services implementation support team, particularly Debbie and Missy, who provide our clients with readily accessible, high-touch professional services. So I'm proud to say that from our mid-Atlantic roots, which began in North Carolina and moved up to Virginia, Adavoco now serves clients in over 25 states across the U.S. and all major nonprofit sectors, whether that be K through 12, public, private, higher ed, arts and culture, church and faith-based, health and human services, historical and preservation societies, and more. So with that said, many thanks again to our friends at Cherry Beckert for inviting us to participate in today's conference, and with whom we share many wonderful clients. And speaking of wonderful clients, special thanks to St. Catherine's School located in Richmond, who will join us a little later in the session to share their story of how we work together to improve their endowment administration. So at this point, I'm very pleased to introduce Adavoco's Chief Financial and Operating Officer, Jason Edwards, who will lead our presentation. Take it away, Jason.
Well, I thank you, Chris. And, you know, I'm coming from Rocky Mount, North Carolina right now. It's overcast and cool. So Hope it's sunny and warmer where you are. But as we move through this discussion today about best practices in endowment accounting, I just kind of wanted to walk through the agenda. So number one, we're going to discuss and share the risk and costs that come with endowment accounting. Number two, we're going to go through some best practices to mitigate those risks and costs. And then number three, we're going to hear from our friends at St. Catherine's School about their experiences before and after implementing some of these best practices. So they're going to be really the coup d'etat when it comes to this presentation. So let's see. So you've joined an organization with a substantial endowment. How great. I mean, that's wonderful. One worry is off your plate, right? Endowments are free money. Well, you know, there's free beer free, and then there's free puppy free. You can be given a free puppy, but it comes with cost and maintenance, food, training, supplies. Endowments also come with costs and maintenance. Consider your balance sheet. What are the two largest items? Most likely, it's property, plant, and equipment, and investments. Think about how much time goes into maintaining your bricks and mortar and how much time goes into managing your investments. By their very nature, in perpetuity, driven by donor stipulations, there are costs for the maintenance to properly administer endowment funds. And when those needs aren't met, you can incur additional costs to meet your fiduciary responsibilities, just like when puppies chew shoes or furniture. We're here to talk about the risk of not properly administering the endowments, and that there are solutions to efficient management, just like there are solutions to raising a successful canine family member. These additional costs can include paying your auditors to do work they shouldn't really do in maintaining the endowment accounting for you. Number two, inefficient processes that require more resources to be devoted to tasks that have very little value. And number three, legal costs to respond to actions by state officials or donors. What you're looking at on the screen is from a University of Louisville Foundation audit report that was more than 250 pages. Imagine the time it took to respond to these findings. Look at that headline. Out of control foundation, blow-by-blow account of unbudgeted spending, unapproved action, and endowment losses. You know, these are findings that they represent issues with policies and procedures, lack of knowledge and oversight, inadequate reporting, and commingling of cash. There's always enough time to do it over, but not enough time to do it right the first time. Really take a glance at what you're doing and put the time and energy into getting it right in the beginning. Here are two examples of findings of mismanagement, one at Texas Southern and one at Payne College. In the case of Texas Southern, we've seen similar poor record keeping, resulting in the inability to determine what came from where. Similar to this example of Payne College, we've seen market values below or slightly above corpus values, even for endowments that date back more than 100 years, which usually can be attributed to borrowing of some kind, whether documented or undocumented. We always say, inspect what you expect. Don't take for granted that your team is doing things properly. When asked the question, why do we have to track this information? Show me the accounting guidance. You can't manage what isn't measured. How do you know if you're underwater if you don't have market values by fund? And I say that, you know, kind of jokingly, but we run into quite a few institutions who are not tracking market values at the fund level. They're doing it in aggregate at the investment level. And there is a requirement to do this at the fund level in order to report out to donors, to track your funds, to know how much is available for spending, how much is underwater. Make sure you are inspecting what you expect. So here's an interesting chart. Structured documented processes are critical to ease the care and maintenance of the report of the endowment. Again, here we're picking on the University of Louisville Foundation. This is from their audit report, and it's an example of cash flows and processes that should be reviewed and simplified. Can you follow this diagram? I mean, there are a lot of moving parts to this relating to where cash is coming from, where it's landing, when it's being transferred, who it's going to, what types of investments you have, and where everything resides. So one of the things that we would challenge you to do is give consideration to mapping out your endowment cash flow process. And mapping this out, you'll be able to do three things. You'll be able to better understand all the moving parts, and there are quite a few moving parts when it comes to endowment accounting. Number two, you'll have a graphic to better assist in training others responsible for endowment accounting. And number three, you'll be able to easily explain the process to internal and external parties. I mean, your auditors, board members, even your president, possibly your CEO, your executive director, they may not completely understand how everything's flowing. And a graphic tends to help with the illustration. So here we are on our first polling question.
Polling question number one. How does your organization administer its endowment accounting? So by far, the number one we see is spreadsheets, but that's option A. Option B, an add-on module to existing financial software, whether that be Banner or Financial Edge or whatever you may be using. A third-party service, a bank, a brokerage, meaning a Merrill Lynch, some other service provider, or what's an endowment? I'm supposed to track these things. So we'll
apologies, Chris. We had an error on our first launch of the question, so we had to relaunch that polling question. So we'll give them a few more seconds to answer the first polling question here. We're at about 15 seconds left. So if you haven't pressed it so far, we've got about 95% who have answered the question, and let's see if you're surprised by the results at all.
Okay. So far, a little. Well, we have 5% coming in at what's an endowment. So we're glad to have you join us today. Looks like most people are tracking in spreadsheets, which would be what I would expect. Okay.
Good deal.
So spreadsheets came in at number one. Bank, brokerage, and other service providers was number two, and an add-on to financial software, which I actually would have expected to be the second choice, and then followed by a distant what's an endowment. Thanks.
Thank you, Chris. So let's talk about what strong policies and structures can help or prevent in these bullet points that were listed here. I'll touch on a few of these. So the first one, loans gone missing in action. Good policies and structures can avoid this. As mentioned previously, we have seen very old endowment pools where the market values are below or slightly above corpus, indicating the possibility of a loan taken from the pool at some point, or it could be an indication of a spending policy in excess of investment returns over a long period of time. It's something to be mindful of, to be aware of, and always know, just kind of be looking at your endowment investments and your fund values and your corpus from what I'll call a common sense perspective to see if it just lines up with your expectations. Other things that you may avoid: gifts not transferred to the investments, or payout not withdrawn from the investments, or a combination of both, commonly known as netting. We see netting quite often. And as long as you're able to track these items and you're netting them and you're moving the money on a regular, consistent basis, you may be okay. We tend to see quite frequently that there are not consistent processes for moving the monies to and from the investment vehicle. And it can really linger. I mean, sometimes we'll see organizations, they'll stretch it out 3 months, 6 months, maybe once a year. We've even seen some go 8 years, which is a little disturbing. And one of the things to take into consideration when you don't have a consistent practice for moving your cash flows in and out of the endowment, you could be utilizing your endowment cash flows as a short-term line of credit, otherwise referred to as due to from. We're all familiar with the due to from, and sometimes we can theoretically say what makes it up, but when it comes down to breaking it apart, we have a hard time. And so we want to have very good, consistent practices to ensure that we are not having that play out in our institution or organization. Good policies and structures can avoid here a few other bullet points. So inconsistent handling of stock gifts. Be aware of the impact of stock gifts on your pool. And we'll talk about this a little bit later in a slide, but please set up a separate brokerage account to run all your stock gifts through, similar to a clearing account. You know, most organizations we see, some will do that, some won't. It's about 50-50. If you're running them through the stock gifts through your existing endowment pool investment account, you could be inadvertently impacting your realized and unrealized gains and losses, since the donor's cost base is what transfers into your investment account when a stock gift is donated to your organization. You got to just be mindful of that. When the donor's cost base is transferred in with the stock gift, and then your broker or investment manager immediately sells that stock, what shows up on the investment statement is a realized gain loss amount that is associated with the donor's cost basis, not the cost basis of when the money landed in your investment account. And it can give a slightly inaccurate view of your endowment pool. It really is. You got to be mindful of it, because it can misrepresent what is an unrealized gain loss and what is a realized gain loss. Other things to avoid with stock gifts: do not run your non-endowed stock gifts into your endowment pool and then sell them and move the money out. You just have all these residual gains and losses that end up being absorbed by funds that had nothing to do with that stock gift. So be mindful of that. And reliance on the big spreadsheet. You know, I'm a big spreadsheet fan. I think we all may be. Here's an example of a big spreadsheet. Is it best practice or job security? I mean, don't get me wrong. I love spreadsheets. I'm an accountant, but there are problems and limitations with using a spreadsheet. You know, some of those could be, there are monthly operational costs to running a spreadsheet. They may not be as efficient as a software or service team that's purpose built for tracking your endowment. They may not be designed specifically to perform endowment accounting. You can make a spreadsheet do what you want it to do with very little controls, and errors can be rolled forward without your knowledge. Spreadsheets are not documented programs with support teams. There can be business continuity issues during turnover. And usually when that happens, it's at an unfortunate time. And a lot of times you're calling your auditor up when they come in to do the work, and they're having to write you up because you haven't done it. You don't know what to do. The person left that was doing the spreadsheet, and then you're relying on the auditor to try to catch it up for you. Another thing to take into consideration is too much detail is a problem, similar to not enough detail. For example, we've seen instances of organizations that are tracking every single security trade of an investment from their account. And what they're trying to do is every month they're breaking down every single stock that was bought or sold, tracking it. They're tracking the unrealized gains and losses with it. And what you have to understand is recognize what's critical to track and what's just a distraction or an inefficiency. Many times there are things you can track in aggregate on a month-to-month basis relating to your investments that you don't need to keep up with the details of every single security at that time. The other thing to keep in mind is spreadsheets are fraught with error, fragile at best. Every time a Davico has been presented with a spreadsheet, there's been an issue. There's some formula error. There is something missing. Something didn't get carried forward. There's a hard code. You just have to be very, very careful when working with the spreadsheets. So all of these decisions made poorly lead to risk and costs resulting from audits. So here you see an example, an excerpt from a management letter. You can get management letter comments. You can have material weaknesses in internal controls regarding financial reporting. The auditor could be allocating the returns and the payout for you, and then they're auditing their own work. The auditor could be reconciling the assets and generating the journal entries for your general ledger. You have to deal with trying to adjust for minor changes in non-marketables prior to the audit report date, which really truly depends on the audit firm you're working with and the agreed upon approach of how you're going to handle those when those alternative investments come in well after, on some lag period, your year end. And then you have accrued interest, to accrue or not to accrue. We see, it's just kind of split. Organizations will reflect it, some won't. Make that decision up front and make sure you track it consistently as you move forward and that everyone understands that. Another thing to consider, don't get into a retroactive approach. And what do I mean by that? I mean, don't focus on your endowment only once per year when the auditors are coming in, just for the purposes of updating your financials and your footnotes. You aren't able to address issues that are happening during the year if you're only looking at it once per year. In other words, don't be playing catch up. So let's take a look at the last sentence on this slide in blue. We recommend that the organization develop a process and controls that ensure that all donor restricted and internally designated funds are accurately and completely maintained on a periodic basis. And there's a lot of key nuggets right there. You develop the process, you have the controls, you're being accurate, you're completely maintaining this, and you're doing it periodically, not once a year. So we're on our next polling question here.
All righty. So polling question number 2. What's the biggest challenge you face when accounting for endowments? So tracking net assets, which is different than the market value allocation. So on the equity side of things, reconciling our due to from, that's always a fun thing to do. Preparing for those audit disclosures when Matthew and his team start knocking on the door, or we don't have endowments. So it looks like so far tracking net assets is in the lead. Maybe some of those fun policy level adjustments, reinvestments back to corpus, that sort of thing.
Chris, and we see a theme as well here, which is, when we do our PBC list for our clients and their audits, a lot of times the last thing to get uploaded is that net assets and endowment reconciliation work paper. So maybe that's telling. Maybe that's telling that it's not the easiest thing to do. It takes a lot of time, and B, it's nobody's favorite thing to do because they always wait till the last PBC to upload that one. So just thought I'd add that.
Yeah. And of course, we start there and end there every valuation period. So it makes it much easier going forward. All right. think everybody's in. So tracking net assets definitely has it by a large margin, followed by preparing audit disclosures.
Good deal. Thank you very much. Let's move on to the next slide here. So we have a quote on the right-hand side of the slide. I inherited a mess, and now I must fix it with little data seemingly available. Signed, your name here, possibly, frustrated. I am sure we can all resonate with that quote. And at some point in our career, we have encountered inherited messes. So here are a few inherited messes on this slide, and we'll have a few more on the next slide. But just to kind of touch on these, you could be inheriting a mess where no one at your organization has ever thought about tracking the market values by fund. We see it quite often, and there is a definite need to be doing that. You could have negative market values. We've seen spreadsheets where some instances happened in the past and a fund has gone negative for some reason, or an institution has allowed the Excel formula to take it negative. And then you begin to see earnings allocated across funds, and negative earnings are allocated to this, or earnings are allocated to the negative fund, taking it further negative in some instances. It just hasn't been addressed because it's not being looked at on a regular basis. And the controls aren't protecting you from when taking it below negative. We've seen perm restricted assets with zero corpus. How does that happen if there's some event has happened and the final cleanup has not been resolved? And then you'll see down towards the end, only one person can follow the big spreadsheet. And we've talked about undocumented loans can be an inherited mess where all of a sudden, it never was picked up by a prior audit firm or any prior controller or VP of finance. And now you're in that seat and the spotlight is on you when the questions start happening. And so, just know what you're looking at and understanding how the data is flowing, and recognize what needs to be done to make the correction. Other inherited messes we have here. So, the first one, incorrect payout withdrawal amounts. So not applying spending payout properly. That can be an inherited mess, or pulling the wrong value out of your fund balances. Sometimes we'll see organizations that will pull the actual expenses or the actual scholarship awards out of the endowment fund versus utilizing a defined spending payout policy. The topic of spending payout could be a standalone presentation given the varied approaches we see across organizations. I mean, you can really get in the weeds when it comes to spending payout, and we see it, those calculations done so many different ways. Other things, inherited messes here, no real checks and balances, allow errors to be carried forward. And, this one's one we hear quite frequently. The auditors never said anything, but you're their only nonprofit engagement and you're the biggest account in town. Sometimes that can have some influence on things, unfortunately. So what I'd like to do now is turn things over to Lori Fuller and Elizabeth Townsend at St. Catherine's School and ask them if they would mind sharing some of their experiences and maybe inherited messes prior to implementing some best practices.
Yes, I am a perfect example of I inherited a mess. Hi, my name is Lori Fuller. I work here at St. Catherine's School, and we also have a separate foundation that has been developed for the benefit of the school. I was a previous Cherry Bekaert employee, so I had audit clients that I knew how to audit endowments, but then when I came here, I was having to account for the endowments. So the auditors for Cherry Bekaert for St. Catherine's School were actually doing the unitization spreadsheets. And that was the mess that we inherited. I won't say who that was, but we had spreadsheets to track the activity for the investment managers. We had spreadsheets to track the funds. We have over 150 funds that are for various purposes of scholarships, teacher benefits, professional development. We even have those that are very specific to a specific program of the school. So we had in spreadsheets that did the endowment footnote. And we all know as auditors how horrible the footnote can be to pull together for the audit report. And so we were using software here. And I looked, Elizabeth and I both looked into whether their allocation module could work for the endowment. It was very time consuming. Elizabeth can relate to this because she did a ton of work to pull this together, and the amount of time to create the funds, the investment managers, the projects, the coding was insane. So I actually was at a Cherry Beckert seminar, and I met Chris there, and we started talking about his company. And I said, I think that could be a good fit for St. Catherine's. So we started talking, and I believe that might have been the last seminar before the pandemic. And so we started working remotely, and Chris and Jason worked with Elizabeth and myself, and they were such great help in helping us work to get this converted.
Fantastic. Well, Lori, thank you for sharing those experiences, and we're looking forward to hearing from both you and Elizabeth in a few slides a little later to see where you are now and what kind of best practices you put into place. You've kind of given us a teaser right there with that last little bit. So let's move to our next slide here. So before we get into sharing how to resolve some of these things and talking about the best practices that you can employ, let's keep in mind the following. What's important to an auditor versus what's important to management. And so I'll kind of go through these, and Matthew, if you don't mind, I may, once I kind of walk through these, I may just ask you if you would mind expanding upon or sharing any thoughts relating to this as well. So materiality, auditors tend to be focused, more on finalizing things within materiality threshold limits, while management, every penny is materially significant to a donor. It has to be tracked to the penny if you're reporting out to your donors. When it comes to your journal entries, the auditors may assist with the summary entry prep for financials. Management is really dependent on the general ledger structure, and you really need to get into the nitty-gritty and understanding the detailed entries to update your general ledger so that it can flow through your financial statement prep. When it comes to reporting, auditors are focused on the financial statements presenting fairly and primarily relating to the audit. And management, they're focused on multiple outlets. They're reporting to cabinets, to departments, to boards, to committees, to donors, to lenders. There's a lot of different reporting outlets that you have to take into consideration, and many of which you need to be very precise with. And then on the controls, the auditor's responsibility is to evaluate and understand. They are not responsible for performing forensic analysis on your spreadsheet, nor should they really be auditing their own spreadsheet if they're doing that for you. And management, your responsibility is to establish, maintain, and monitor the controls. The buck stops with you. If there's a formula error or incorrect entry recorded, or, I'm sure you can fill in the blank. So Matthew, what are your thoughts on this that you mind sharing?
Jason, I think you guys have hit a lot of really good points on this. As an auditor myself, I think there's oftentimes probably a false presumption that just because you have a clean financial statement audit, that we have gone in and done detailed testing over every single endowment fund that the organization has. And I think, a lot of times people are looking to the audit opinion as being, as long as the financial statements are not misstated, everything with endowment management must be on the up and up as well. And as you know, it's just not the purpose of a financial audit is not to opine down to that level of accounting within an organization. So I think it's really important that people understand that. The other thing is, I think when you talk about management and sort of the audiences of this, so much of the audience is the folks from your development staff and your donors that have established these endowments. And I think oftentimes, primarily everybody's focused on the audit, the financial statements and footnotes, reporting to the board, and the original donors who established these endowments that have grown to millions of dollars are sort of an afterthought. And really what cultivates, additional giving is reporting back to those donors on just the impact that their gifts have had to the institution. So donors are delighted when they can receive a very, clean, formal looking report that shows the students that receive scholarships from their funds or these types of things. That just delights donors. And then, of course, they're talking to their fellow trustees, their fellow alumni or friends. And that's what's going to cultivate new gifts to the endowment, is seeing that impact and seeing that story of how the dollars are impacting the organization. So different audiences, different things that are important, and you got to really consider all of them. And the spreadsheets just don't do that, right? So
right. Yeah, no, that's perfect, Matthew. Thank you for sharing that. And so it looks like we have another polling question coming up. So let's see what we have here.
All right, polling question number 3. What's your spending formula based on? So trailing average at fund level bottom up, meaning you're calculating your payout for every fund in the pool, or trailing average at the pool level top down, where you're taking the aggregate of all the investment balances and doing your calculation, whether it's a trailing 3, 4, 5, whatever the case may be, and then pushing those results down to all the individual funds when you value your pool or do your allocations. A percentage of prior year market value. You're just taking the prior year's market value and applying some percentage to whatever that number was. Or we don't have a spending payout. Maybe you don't have endowments, or maybe you just haven't thought about the spending side of things. All right, so this one's a little bit closer so far. We've got trailing average at the pool level, the top down, the aggregate approach, we call it, at 29%, and a percent of the prior year's market value, a little bit higher than I would have thought, at 27. We don't have one at 27. I'm going to assume those are organizations, 27%, that just don't have a need for endowments or don't have those endowment pools set up yet. And finally, the trailing average at the fund level, the bottom up, which we do accommodate and see fairly frequently, because that gets to be a bit of a more robust calculation, but that's coming in at 18%. So thank you.
Great, thank you, Chris. So let's get into some best practices here. Our solutions checklist. All of the previous angst can be avoided by good decisions and effort in the following areas: experts, policies, structure, software. And we're going to touch on some bullet points within each of these 4 points. But notice the quote on the right-hand side: an ounce of prevention is worth a pound of cure. Let's really go into mapping things out and planning things. So let's talk about our experts first. Experts. So leverage the experts around you and the services you're already paying for. Your auditors, they should be viewed as a resource to assist your organization rather than shying away from them for fear of how your question may look. Your investment advisors, utilize the reporting at their fingertips to provide materials to your boards and committees rather than trying to create your own stuff. You know, you're paying them for the job, get the reporting out of them. The custodians, great ones, can make your life much easier with reporting options to eliminate on the side spreadsheets that you may have created or inherited. And then lastly, subject matter experts, a great resource available that few even attempt to utilize or tap into, although most of those experts have a passion to help. So consider these 4 experts as part of your best practices booklet. And then we move into policies. So great policies, you know, have a gift acceptance policy, collaborate with your fundraising peers to outline what works best for the institution rather than operating in silos. When it comes to investment policies, this is a key one. Be prepared to educate your investment and or your finance committee on the decisions that they may want to make, but they may not understand the time and cost to administratively carry out those decisions, especially when it comes to getting into some, you know, alternative type investments or options and things like that. Your spending policy, you know, take a peek at the 7 UPMIFA factors in your footnotes and learn how to analyze and measure how you're carrying those out. And then the last one, a naming policy. You know, have a minimum size of gifts to establish a named endowment. One of the things we like to say is, you know, without a policy, chaos ensues. So structure, you know, let's look at this. I'll just kind of read the first one here. Standard gift agreement templates and a process for handling exceptions. So exceptions, interesting word there. They live forever, and there's a cost to tracking exceptions. Software helps, but exceptions are still costly. Remember the old De Beers tagline, a diamond is forever? Well, exceptions can be forever too. In one of my former roles, I was referred to as Dr. No. They used to laugh and say, because I said no so much. I'd like to turn it around and say, well, that's Dr. K-N-O-W, you know, as in no. I encourage you to be a Dr. No, like Dr. K-N-O-W, to assist in educating and shaping the structure of your organization. And the last bullet point for our best practice here is software. You know, audits are designed to make sure the financial statements present fairly within a materiality level. And the auditors are performing their financial statement audit. They don't have the responsibility, like we talked about, to do the forensic analysis on your spreadsheet. It's your responsibility. If there are issues, donors and state officials are going to come to you. They're not going to come to the audit firm. When you have endowment accounting and unitization software, there's no such thing as materiality. Would you tell a donor their fund wasn't allocated the full amount of investment returns, or the spending distribution was too high because their fund was below the materiality threshold for investigative differences? Probably not. Their named fund is materially significant to them. Endowments are one of the most error-prone aspects of endowment accounting because it's a top-down approach, and it doesn't force a close look at investments and fund balance relationships. In this instance, any outages are usually viewed as a reconciliation at the bottom of the fund balance spreadsheet, a catch-all. Instead, Adabaco uses a bottom-up or sum of the parts approach, putting a magnifying glass on the relationship between the assets and the fund balances, regardless of audit materiality threshold. There's no such thing as materiality in unitization. Lastly, sometimes cost can be a prohibitive factor when it comes to software until organizations realize that the costs aren't as high as anticipated and may be paid out of the endowment, very similar to investment manager fees. So here's our last polling question.
All righty. What is the biggest hindrance to improvements in accounting practices within your organization? Time. It always takes time to do that due diligence and make those changes. Money, as Jason just mentioned. Staffing resources. trying to already do more with less and turnover and things, or my favorite, and I can say this as a recovering auditor, it works, why change it? So the CPA's mantra. All right, so we see staffing resources coming in, half of you with that, followed by time, and then a close second with money, and it works, why change it, at 7% so far. All right, I think that's it. Staffing resources has it.
There you go. Thank you, Chris. So now I'd like to turn things back over to Lori Fuller and Elizabeth Townsend at St. Catherine's School. Do you mind kind of picking up on that conversation you were telling earlier to share with us some of the things that you've highlighted in the form of best practices at your organization?
Well, as Lori talked about earlier, we had looked at other software, and as pointed out, add-on modules to our financial software just didn't seem to work properly, and the third-party services were too costly. So when we found Adavoco, we were really intrigued at what they could do for us, and they had a really hands-on approach. They didn't put the onus on us to load all the information and to get everything up and running. And what happened to us at the reconciliation process was, so we were not aware of any problems, but what the reconciliation process provided us with a view through a separate lens, a different lens, I should say, and pointed out some reconciling items for us. And in a positive way, it really forced us to kind of take a deep dive into our pooled assets. And in doing that, we were able to really tidy up our process for a more accurate and user-friendly pool. And what I can say is our development office is so happy. They're thrilled to be able to have accurate, up-to-date information to provide to donors. I don't dread that awful footnote at the end of every year, and while we did spend time doing what was necessary to get into coming up with our pooled assets. We did, it was time well spent, and Adavoco was right with us the entire time, answering all sorts of questions, sounding board. They were great.
Well, Elizabeth, I'm wondering, because I think you guys mentioned this to me as you went through this process, the time and energy that you spent in the spreadsheets versus after implementation and that. Can you give us an idea, just hours a month or a year pre-implementation and post-implementation?
We were unitizing on a quarterly basis, which is a whole another issue. So, oh gosh, those spreadsheets are just, they're just all awful. I can't even.
Your face and reaction really is probably more telling than any answer could be. But I know that, yeah, you're unitizing on
days,
much more frequent. Yeah,
days, I would say. You easily spend 3 days unitizing, and then at the end of the year, oh my gosh, weeks.
Yeah.
Well, I think
not now.
as Jason mentioned earlier, there's just a lot of moving parts, and that's where when people try to make, and again, I think Excel every day. I wake up because it's why my company exists. But when you're trying to do all of this and wrangle all these moving parts in an Excel spreadsheet, it can get a bit overwhelming at times. And really, the purpose of a system like ours is to keep assets and fund balances in parity at all times. And if they're not, to understand why. And so, Matthew, when you were talking earlier about that net asset, the responses on the net asset question, we start there. And once we get that information loaded, we end there, whether it be every month or every quarter. So then when we do get to the FAS 117 disclosure and the endowment footnote disclosure, it's a push of a button. There's no additional steps or heavy lifting that's required unless there's things that are outside of our purview, like trust held for the benefits of others or pledge receivables. But those are very easy add-ins to our footnote. And so, Elizabeth, I think that's probably, and Lori, some of what you hopefully experienced. And then as a result, when Matthew and his team came in, it was a much different user experience from the audit side too. And then of course, having that monthly valuation is typically a real plus for the advancement team who wants to maybe have those more frequent touch points with donors, or at least have the option to.
I would like to add the one thing on this slide. We have been very fortunate that we've had a very consistent audit team, but when you're using Adavoco, the standard reporting that you get, all of the auditors are going to understand that. So if you have a change in your team, you don't have to re-explain everything that you're doing in your spreadsheets, because the auditors will be familiar with these reports that they are using with other clients. So I'd say that has been a significant advantage for us as well.
Mm-hmm. Yeah.
So we are at the end of our time for this session. We did have one question that I wanted to throw to the panelists. All the polling questions are in, so everyone will get credit. But the question has to do with just curious if someone doesn't have an endowment currently at their organization, is there any benchmarking? Is there any sort of size that would prohibit or prevent someone from starting an endowment? Or Chris, Jason, maybe since you see a lot of different organizations, anything on sort of what you typically see before someone says, hey, let's create an endowment fund?
Well, I'll answer it this way. We see some fairly small, particularly churches, faith-based organizations will have some small endowments, and the challenge is how to account for those. And sometimes they're still trying to do the one-to-one relationship, one endowment and one bank account, and you'll see 6 or 7 different accounts at a bank where they're trying to separate out the endowment. So I don't know that there's any particular minimum size that we've seen for endowments, although most institutions, once they have ongoing programs, will have minimums to set up an endowment, whether that be 25,000 or what have you. As far as clients we work with, we have clients that are, $500,000 on up. So, we have different programs that are available to try to make sure that they're accounting for their endowments correctly, because I'm not aware of any provisions in MIFO or FASB that say you don't have to do it correctly if you're under a certain size. Or Matthew, if you know of one, please share it with me at some time.
Yeah, I will. I have one more question that just popped up. How much time does it take to close the month out and have donor reports available for distribution on average using your system? Jason, do you know that?
Sure. Yeah. I mean, the way it works is generally, we get the information from the institution. Generally within about 24 to 48 hours, we finalize the processes and your reports are ready. If you have a tight schedule that you're working against, you can let us know, and that schedule can get ramped up to meet your needs.
The only caveat I would add to that is, obviously, if you have investment assets that are lagged, non-marketables, things that trickle in, then we have to accommodate for that. So, but if they're all in an ideal world readily marketable as securities and they come in timely, then it can be a fairly quick turnaround process. And there is no close procedure per se that needs to be done, because every valuation
Right.
period in our system is in fact its own close. Lori, Elizabeth, I don't know if you have anything to add in terms of timing, which you've experienced.
Once all the investment statements are uploaded, which is on me to get those, I've never experienced anything more than 24 hours as far as turnaround.
Good.
That's awesome. That's really awesome. Well, hey, thank you so much. That's all the time we have. And I thank everybody for joining us in this first session today. So Jason, Chris, Lori, Elizabeth, their contact information is in front of you, the email addresses. I am sure Chris and Jason will be happy to follow up with you. We've had several questions just about more information. And they do set up free consultations and demos. And then Lori and Elizabeth, hey, if people want to talk about your experience a little bit and get a referral, hopefully you'll be able to allow people to reach out to you as well if they want to follow up. So with that ends our first session, and we will see you next at 11 a.m. Eastern time. Our next session is going to be on outsourcing. Is outsourced accounting right for your not-for-profit organization? I know it's a topic that lots of folks are thinking about as staffing challenges continue in the wake of the pandemic. So we'll see everyone else at 11. And again, there's a short survey that was posted to the chat link as well. So you can click on that there, or it will also pop up afterwards through email. So thank you very much, and we'll talk to you and see you soon.